S&A Investor Radio looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street, right to you on Main Street.
How's it going out there? It's Wednesday, January 29th, and I'm Frank Curcio, host of the S&A Investor Podcast, where I break down the headlines and tell you what's really moving these markets. You know, I was talking to this friend of mine a few days ago. Great guy who I play basketball with. He's 62 years old. Don't let the age fool you. This guy's in amazing shape. Play golf with him. He outdrives me. Just, I don't know. Like I said, in northern Florida, it's like the Fountain of Youth down here. If I go to YMCA to work out, you got, 7-year-olds shooting basketball with me, doing pull-ups and everything. It kind of motivates me. Great guy. And he starts asking me questions about the market. And, he knows that's my field and everything. He goes, Frank, I have about $750,000 in a retirement account. And this guy has been in business all his life. He's doing good. He saved his money. He's just, and he's pretty much, looking forward to retirement. So he said, I can't touch it until I'm 70 years old. I don't know what to do with it. Yeah, I've been out of the market for about 2 years, scared to go back in ever since 2008, which sounds familiar to a lot of retirees, right? But he sees the market pulling back over the past week or 2 weeks or so. And he goes, I'm thinking about buying some big dividend-paying stocks like the IBMs, the Exxons, the GEs. Then he says, Frank, what I want is big returns, like 10% plus returns, but I just don't want to take on that much risk. So he asked me, should I put most of it, take a large position in GE? Maybe that's the way to go. And I have to say, and I'm bringing this up because I've got so many questions on it from retirees, especially in the past 3 weeks or so, and recently since the market's coming down. And I have to say, talking to people gives you a good sense of what the common person is thinking about the market, the economy, gives you a gauge on sentiment. That's why I love this podcast. So many people email me all the time. It gives me a good perspective of what's going on around the United States and around the world because this podcast is global. I mean, you don't really get that from CNBC, which flashed a headline, I think it was last Friday. It says, your money under attack. Your money under attack. The market's down. I love it. It's just, you have to remember. You have CNBC, Fox, even the major papers. And I'm on these shows. I'm not ragging on them or anything, but they make money through advertising. And they get big bucks if more people watch their shows and read their newspapers, like the Wall Street Journal or whatever. And they do that and get more people to watch based on scaring the hell out of everyone. That's easily, that and creating controversy, like Trayvon Martin. And was that racial? No. I don't want to get in more emails of Stansberry.com, but still, and to me, it wasn't racial at all. I mean, was it a forced situation? Absolutely. I won't get into it. I'm just saying, the more controversy you create, the more people are going to watch, more people are going to care, more advertising dollars. That's what that's about. For me, my newsletters, I make money by people subscribing. They subscribe to my newsletter. I want them to be subscribers for 20 years because I give them good advice. If I don't give them good advice, you know what? You're going to cancel. But I can't buy the stocks I'm recommending. There's no conflict of interest, nothing. Just I have to give you good advice or I don't make money. That's it. You're not going to buy my newsletter. You're going to cancel. Anyway, I learned a lot from my conversation with this friend. And a few things, right? Remember, I mentioned he wants to take the whole position in GE. You never want to buy a full position in one stock. Because you could have an Enron, a WorldCom, and people might be listening and saying, Frank, it's GE. Well, GE would have went under if the government didn't bail them out. Look at the numbers. Look at their debt position. They were allowed to lower their interest rate incredibly. They were done. They were a goner. And they're one of the biggest beneficiaries, along with the banks, that would have went under. But you never know. You never know. Do I think GE is going to go in? No, I don't think so. The government would never let that happen. It's America's company. But you never want to take a full position in one stock because you never know. It could go down 20, 30%. Who knows? I mean, you thought Apple was a great buy at $620, $650. I mean, it was $1,000 target prices. Right now, everybody downgraded after the quarter. You're getting $500, $550 target prices. They cut in half. How many $1,000 target prices did we see on Apple a year ago, 18 months ago? I could think off the top of my head at least 3 or 4. This person also, he doesn't trust the markets, and he doesn't want to lose a dime. He's scared to own stocks. It's just interesting. I hear that from so many people that are not in the markets. I can't go through 2008 again. You don't understand. And until you've been in that position as a retiree, I'm not a retiree. I talk to a lot of them, so I understand that position. But a lot of young investors, and by young, maybe 30 to 50 years old, and you don't understand when you're done working, you have no more working power. You're 60, 65, you see your house get cut in half, your 401k get cut in half. You're like, whoa, what am I going to do? What just happened? You can't go through that. The emotions are crazy. I mean, if you're 30, 40, 50 and lose everything, you still got another 20 years working, whatever. You can get out of that. When you're older, it's a lot more difficult. So I understand where he's coming from. I mean, another thing that I noticed of what he said, I want big returns, but not a lot of risk. I mean, his goals are unrealistic. You know, if you want a safe portfolio, you won't be able to generate double-digit annual returns. If you want a purely safe portfolio, it's very difficult to do. In other words, you're going to have to take on some risk to generate those types of returns. That's what small cap investing is all about. You're taking on more risk to generate higher returns. And that brings me to the point of this introduction here. If you're a small stock specialist subscriber, you already know about the small portfolio stocks that I recommended over the past 12 months. I have 5 stocks in this portfolio that should be bought instead of buying McDonald's, Coca-Cola, GE, Procter & Gamble. Yet I'm sure nobody will ever buy these companies instead of these blue chips. They love McDonald's. They love their GEs. And I spent a ton of research on it, something I'm proud of because I don't know anyone else that recommends these stocks and has this strategy. You're not going to hear it on Wall Street because these companies are boring. A lot of them aren't even covered. They don't need to raise money. So nobody wants to deal with them. When you look at Wall Street makes fees by trading. But, you know, these companies, you could do yourself. You buy and hold them forever. That's it. That's the strategy. That's it. It's like buying McDonald's in the 60s, 70s, 80s, those blue chip stocks that are through the roof today. Again, spent a ton of research on it. I came with one conclusion. There's not one reason I can think of why you should own the McDonald's, Coca-Cola, Procter & Gamble, GE over these companies. You might say, Frank, why is that? What do these companies do? I mean, let's start with dividends. By the way, I'm doing this intro based on the enormous amount of questions and feedback I've been getting from retirees. I'm not promoting my newsletter. I'm not doing anything, honestly. I'm just telling you, giving you an alternative because I've gotten hundreds of emails. People that are nervous about the market, buy these stocks. They're safe. They'll generate a ton of income for you, and they're much better than buying, as I'll explain right now, the McDonald's and Coca-Colas. If you're looking at these small cap companies, they pay between 2 to 4% yields. That's higher than most large caps, much higher than the average S&P 500 company. You may say, Frank, McDonald's raises dividend every year. Well, these 5 companies have been raising their annual dividend just as long, if not longer, than most large caps. All of them raising for more than 20 years. You know, some people might say, McDonald's is a stable business. I see McDonald's restaurants every day. I drink Coca-Cola. I use Procter & Gamble products. I know they're not going anywhere. These 5 companies, I bet you either saw or used their products over the past week, yet you never even realized it. Because they don't market like the McDonald's and Coca-Colas and Procter & Gambles. Plus, these small cap stocks have been in business from 30 to 150 years, longer than most large caps. But there's a significant difference here, the reason why I like these companies. Especially for early retirees looking to generate higher returns, or like my friend John that still has, 8 to 10 years till he retires. See, these companies are growing much faster than large caps. I mean, how much more can McDonald's and Procter & Gamble grow? You're looking at their sales. They're struggling to grow their sales. They're just so big. They're everywhere already. These small companies are not. Plus, many of these companies are trading at cheaper valuations. And most people don't look at the valuations of McDonald's. They just buy them these days and say, hey, I need that yield. I want to be safe. McDonald's trades at 6 times book value. Procter & Gamble trades at 17 times earnings. Coca-Cola, 5 times book value. I mean, this is much higher than the historical averages. And you could say, sure, they're trading at these levels because interest rates are low. Investors are looking for yield. Yeah, I get it. I understand. But buying them today is the wrong strategy compared to buying these companies that are just as stable, businesses that you use almost all the time. But you're looking for yield in the wrong place. And this is what I explained to my friend. Don't follow the herd and buy these blue chips, which, I've been following these blue chips all my life. They're good companies. If you own them, keep owning them. Hold them. They're good. You generate huge returns. You generate income. That's fine. I'm saying right now for people saying, like his account where he's in cash, buy these small cap dividend payers. They all have market caps of greater than $1 billion. They're all like $200 million market caps. So you're like, whoa, this is a crazy strategy. Again, these have been in business between 30 and 150 years, these companies. They've been raising their annual dividend for 20 consecutive years. They're cash flow generators. Just nobody knows about them. And if you're interested in this portfolio, which includes, the 20 or so stocks I have in my entire portfolio along with this, then, I'm going to give you one last chance to subscribe to my newsletter for $39. That's for the entire year. I'm doing that just based on a ton of emails. It's not a sales pitch. Guys, it's $39. I'm not going to make a fortune. I'm not going to be, hey, well, honey, we're going on a cruise because I sold my newsletter for $39. Now, I'm doing this because I have a good subscriber base, guys that care, guys that email me all the time, tell me about their businesses, tell me about the economy, how's it going. That's why I'm doing this. For $39 the entire year, you'll get those 5 stocks. You'll get exclusive write-ups on those. They're fantastic. I'm telling you, you're going to explain these businesses. You're going to be like, whoa, this company does that? Wow, I use that all the time. I just used it yesterday. I just saw this company the other day. I didn't even realize that was an actual company. When stable businesses that generate cash flow, that have the potential to generate those double-digit returns when you're compounding. You're compounding that yield on the capital gains. And this is the place to be compared to the large caps. I know Dan Ferris will send me an email and say, Frank, you're crazy. Doc sent me an email. I'm telling you, they're wrong. This strategy is much better. You're buying these companies. You're buying the McDonald's and Coca-Colas almost as if you would in the 1980s, the 1970s. And you're going to be holding on for the next 20, 30 years. This is a strategy. This is how it works. And it's a great time to do it because of the market. I'm getting people nervous. The first decline in what? Since last November, right? November 2012. It's straight line, straight up. Now we're coming down, 3-4%. People are like, oh my God, you got to watch out. Holy cow, be careful. Again, not a sales pitch. You see when the markets are getting nailed, you have guys like, Dent on yesterday. He's got a new book coming out, Favor, back on TV every day, calling us telling us basically to buy caves because, the world's about to end. Make sure you buy a cave. Yeah, you get nervous and stuff. This is like the nervous portfolio. This is really good. I'm very proud of this because it's small caps. People don't understand. Nobody really knows about it. And I really love these stocks. I know it's something that's a safe portfolio you can hold on forever. Much better than buying large caps right now. I just want to bring up that story. If you're interested, fkersey@stansberryresearch.com. Again, that's $39 for my newsletter. You have to email me, fkersey@stansberryresearch.com. If you want it, that's fine. If not, don't worry about it. I'm just basing this on the numerous emails that I've got over the past couple of weeks. Now, have a great show for you today. My guest is John Doody, the best gold analyst on the planet, who's had a rough year or rough 24 months. Been doing great this year, though. Gold prices, stocks have been the worst performers over that time period. But I'm bringing John on today because I think he can make a fortune on select gold stocks, an area that I just started buying for my newsletters. And Doody's here to give you his favorite picks, talk about what gold price is heading. It's going to be a fantastic, fantastic interview. Then I'm going to break down the markets, including Apple's quarter, right? Got nailed. The whole world said it's going to be a record quarter. It's going to be huge. And iPhone sales did not come in as strong as expected, and the stock got hit. I'm going to talk about the recent weakness in emerging markets, get a lot of questions on that, and when and why you should be buying right now. And finally, in my educational segment, I'm going to talk about the greatest trend in the world today. Hint, it's in the technology sector, yet it's not big data, it's not cloud computing, or social networking. It's going to be interesting. But first, let's get to my interview with John Doody, editor of Gold Stock Analyst, and here it is. We are talking to John Doody, editor of the Gold Stock Analyst newsletter, 30-year plus veteran of the gold markets. John, I want to thank you so much for, again, being on the S&A Investor Podcast.
Always glad to be joining with you, Frank, and very happy this year since we're starting off the year with a boom in the gold market.
Yeah, I can tell you.
Mini boom, anyway.
Yeah, I can tell you. I saw the returns this year so far. Your top 10, you're doing great. Before we get into that, I wanted to ask you a couple of questions about the downturn. It's been a brutal 2 years for anybody in the mining sector. I wanted to ask you, someone who's been in so many boom and bust markets, how does that market compare to past busts where you've seen, gold stocks get hammered, you've seen gold prices come down? I mean, how does it compare to the other pullbacks that you've seen in the market?
Well, if you want to look at the most recent pullback, which was in the financial crash of '08, October '08, it wasn't quite as bad, but it was still, everything was down over 50%. But this is exactly why you buy the gold stocks, though. They give you leverage to the gold price, and you have to be very nimble. We're not always nimble, we know, but by owning the stocks, you can do 2 or 3 times better than gold itself, or you can do, worse than gold itself. And there's not really any markets that I'm aware of that give you that same kind of leverage to the price of the underlying commodity. And when interest rates go up, the banks don't go down by 50%. So it's a leverage market. I think people don't understand often the risks involved. They think that the past is going to continue in the future. And as you know, our track record for the last 10 years, not including last year, was up over 1,200%. But last year we were down 50%, and that's the price you pay for being in a very explosive market to the upside. And of course, this year we're back on the uptick. The top 10 are up 21% so far this year, whereas gold's up 4%, and the XAU Gold Stock Index is up 6%. So it's a tough market. You either stay in it or ride it out, or you have to try to pick your spots and get in and out. And that's very difficult to do, because once you're out, you never know when to get back in.
You brought up an interesting point, how, gold stocks, you can make so much more than where gold prices are trading at 2 or 3 times those prices. The question I have to ask you is, because I see so many people on blogs, and really smart people, they'll put up a chart and say, well, if you compare prices today to prices like 5 years ago or whatever, and you throw in the junior miner index or whatever, stocks, gold stocks are really undervalued. But I feel like they're missing a major component, which was the big change in the industry. Sure, gold prices got nailed, but you're seeing a lot of gold stocks get hammered because of, it seems to me, production costs have gone up through the roof. I mean, have you seen them go up this high in such a short period of time? And is that a risk this year for stocks?
Well, I can remember back in the early 2000s when it cost $200 an ounce cash cost to produce an ounce of gold, and the stocks weren't doing that much because the gold price was $300. So it's a question of the margin, the differential between the cost of producing an ounce and the gold price itself. And while the gold price has gone up, the cost of producing has gone up along with it. And part of that's just due to energy costs, which are about 25% the cost of producing an ounce of gold. So it's you don't get the energy expansion or the margin expansion that you might like. But this is why you have to pick gold stocks. You can't just buy the indexes. The indexes, I mean, just as an example, the XAU, which is a big gold index, the one that everybody benchmarks, including us, is up 6% this year. But our top 10's up 21%. Now, why is that? Well, we have very few stocks in the top 10 that are also in the XAU, because that includes Newmont and Barrick and the elephants of the industry that can't dance, that don't move very well. On the other hand, we don't have the smaller exploration stories because they don't have any numbers to crunch. We like to do comparative analysis and who's cheap and who's expensive versus the industry averages, and that's that sweet spot in the middle of about 60 stocks that we follow that have the potential to do well, and it's up to us to identify them. And this market's kind of unusual. At least in the start of this beginning of the year, we basically, in our top 10 portfolio, we look at 3 different types of stocks. One is growth producers, companies that have got a defined pipeline that's not based on exploration, it's based upon projects that they've actually got, or in a feasibility study, or a building, or whatever, a defined pipeline. And we like companies that can grow to over 1 million ounces a year. And we like the royalty companies because they're the least risky of the industry. And we also like developers. And this market is turning into an acquisition-driven market where companies are increasingly looking at miners as acquisition targets. We saw Goldcorp is buying Osisko, Argonaut is buying Primera, is buying Brigus. Last year, New Gold took over Rainy River, and the 4 stocks that we have in the top 10 portfolio that we see as potentially as acquisition candidates, but they're currently either building the mine or about to build the mine. They're just completing permits. These are not risky situations. None of them are in risky nations like Ghana or even Peru. There's no issues involved there. The 4 stocks in the portfolio are up 40% this year, and that's really what's driving the portfolio. And these are all companies that all stack up well on the metric that most miners start with when they start looking at acquisition targets, and that's that there's 3 things they look at that the 3 costs they figure out on a cost per ounce of proven and probable reserve ounces that they're buying, and when these add up to under $1,000, then the company is an acquisition target. And basically the way that this works is you take the purchase price. What do you have to pay for the company? And you divide that by the proven and probable reserves of the company. You take the capital cost. What's it going to cost to build the mine, if it's still got to build one? And divide that by the cost per proven and probable reserve. And then what's the cash cost to operate the mine once it's in production? Of course, this has to come from a feasibility study, which all of our companies have. So what's the cash cost to operate it? When those three items all add up to a less than $1,000 an ounce, you've got an acquisition target. And that's a very important metric. Of course, there's other things that have to go into the analysis, but that's where they all start. And these four companies that we have in the portfolio all meet that test, under $1,000 total cost of acquisition.
And I love the fact that you're going over your methodology here, and I know you even a lot better than this, where you're talking about people like, wow, there's a lot of work that goes into it. But keep going even further, because there's a couple things you mentioned. Peru could be a risk, and how important is geography, management. You also talked about, well, you haven't talked about, but I know you actually visit these mines and talk to management on the premises where you take a look. I mean, it's not just, hey, a guy sitting in his office writing about gold stocks, looking at numbers. It's a lot more research than that, isn't it?
Yeah, it is, and it takes a lot of time to go visit a mine. But the interesting thing is not so much the mine itself, but the time they spend that you get to spend with top management and talk about other things and get a sense of what's driving them, what are the metrics that they're really looking at, what's making them want to be in this business, and that's as valuable as actually seeing the mine itself or the site itself in terms of coming to an assessment about what the quality of the company is. And you cannot have it can be the best gold site in the world, but if you've got rotten management, they're going to figure out a way to ruin it. And so you really need guys that have got a track record, that they know what they're doing, and they have a good team around them. It just can't be one head honcho. It's got to have a supporting cast, because mines are very difficult issues to build. It's not like building a factory. Once you turn it on, it's going to run right like a light bulb or something. Mines need continual human input, because there's always problems that come up. Mother Nature is irregular in the geology that she gives you, even in an existing or fully drilled out mine situation. And it just takes a lot of brain power, not just from the head guy. So and usually on a conference call or you're talking to a company, you're only talking to the head guy. But when you get out in the field and you see the team of people involved, then you can really assess what the abilities of this company are.
Once again, we're talking to John Doody, expert gold analyst, and I wanted to talk to you about gold prices itself. You're saying in 2014, you already talked about the gains. We're seeing gold prices go higher. Is this just a rebound from capitulation? Because, of course, you're going to see tax laws settling, especially in the year when almost everything else did well except for mining stocks. Window dressing, where you have a lot of portfolio managers saying, all right, let's get Cleveland Cliffs, Cliffs Resources, off the books right now because it's been doing so bad. Or do you think this can be sustained? Do you think you finally hit bottom and we're ready to rock and roll in the gold sector?
Well, you certainly nailed it, that there was a lot of window dressing and portfolio cleansing. It happened twice last year, once in the middle of the year when gold was driven down just under $1,000 or $1,200 an ounce, down to around $1,180. And then it happened at the year end when basically more fund managers gave up on gold and they just dumped it because they didn't want to have anything that had gold related in their portfolio to show to investors at the year end. And so there is a rebound aspect to that. In terms of how the stocks are doing at the beginning of this year. But on the other hand, we've learned a lot in the last year about what it really costs to operate a mine, and the metric that companies typically used up until last year was the cash cost of producing an ounce. That was the direct cost of producing an ounce, the labor, the explosives, the energy. What did it cost to get an ounce out of the ground? But it turns out that number tells part of the story. There's another 30 or 40% that needs to be added on to that for costs that typically get capitalized or don't show up in the P&L on an ongoing basis, and those are costs that have to do with exploration. What's the capital cost that has to be spent? Do you need to, when you lay back, when you're doing an open pit mine, you have a stripping cost to lay back the mine to the walls of the pit to open up more reserves below. Well, that stripping cost has to be paid, but it doesn't show up in the direct operating cost. It's a capex cost that then gets depreciated over the ounces produced. So it doesn't show up in the cash cost of producing, but you've got to lay that money out in order to push back the mine pit walls in order to get to the gold. So we've learned a lot, and coming to the forefront is this new concept of all-in sustaining cash cost per ounce, and that's a much bigger number. That whereas the average cash cost for our producers last year was about $720 an ounce, the all-in sustaining cost, which includes everything, is more like $1,150, $1,200, $1,250 an ounce. And that's really a better metric of how the companies are doing, and it's something that people are now paying much more attention to.
Yeah, it's definitely.
And at that price, $1,250 an ounce, if that's where you're at, you can't make any money at a $1,250 gold price. So that means that companies are cutting back on production. They're either high grading, they're taking out the richest parts of the ore if they can find them, or they're just slowing down production and not increasing their production rate. They're just marking time, waiting for the gold price to rise.
Yeah, that's interesting too. How we're seeing so many companies now cost cutting, laying off. Just finding ways to produce higher margins because you're not seeing sales rise as much as earnings. And I wonder if you're going to go through that with gold as well, where a lot of these companies, like you said, if your production costs are $1,100, $1,200 or higher, you're in trouble. You're not ready to make money on the only product you produce. And it's going to be interesting how they cut costs. And I'm glad you said that because I didn't know that they're developing, obviously the best part of their mines and hoping that prices come back. But it's just, that whole curve right now is going to be interesting, especially over the next year. And I guess the companies that could do that are really going to go higher. Which brings me to the next question here is you mentioned royalties earlier. Talk a little bit about royalties because I still feel that, and I just recommended a royalty recently, not one of the ones that in your top 10, or a small cap one, but there's I feel like people don't understand the royalty model where, they don't produce, they're not producers, they're more like financiers and take positions in different projects and everything. But talk about the royalties because that's where I think the biggest money can be made because their costs are so low.
Yeah, the actual cost of operating a royalty company is pretty low because, even the biggest ones only have 20 or 22 employees. So, that's a very small number of employees relative to the size, to the market capitalization, and to the revenues. But basically, the royalty companies get to piggyback on the back of producers, but they don't have the aggravation of running the mine, and they don't have to take the risk of lower price, squeezing the margin on the operating cash margin of the business. And the royalties typically operate on two different bases. One is either they have a percentage of sales, sort of like a sales tax, and a typical royalty might be 1.5% to 3% of sales, or that was the original way they started out, and that percentage of sale basis still pays a lot of money to a lot of royalty producers. For example, Franco has a 5% sales interest and a 5% net profits interest on Barrick's Gold Strike mine, and that's been a 2 million ounce producer for the last 30 years. And Franco has typically made $25 million a year or more off of that mine, just from having this slice of the mine's income, the gross income on the sales royalty and the net income on the profit royalty. But then there's another financing method that's developed of late, and that's called streaming, whereas instead of selling additional shares to build a mine, a company might sell an interest in the production of a mine, and usually that's a fixed number of ounces per year at a fixed price. For example, one of the early ones was the Andacollo mine that Royal Gold bought, where they basically lent Teck, which was the developer of the Andacollo mine. Teck wanted to build a mill in order to process sulfide oil, ore there from the mine. But the time was 2008. Teck was in financial trouble, and they couldn't raise the money, the $260 million that they needed in order to build the mill. So they did a royalty deal, a stream deal with Royal Gold, where Royal Gold essentially gets 40,000 ounces a year out of the mine for nothing. They pay nothing for this. So 40,000 ounces, even at a $1,250 gold price, is $50 million a year, if my math is right. And it was worth it to Teck because the $260 million let them build a mill that let them recover a lot of copper that they weren't going to get otherwise. And that copper, I don't know what that's producing for Teck now, but I'm sure it's been a worthwhile investment. So these streams have been now that was one of the first and really one of the best ones. Most streams now the companies pay around $400 an ounce for the ounces of gold, and a good one was one that Coeur d'Alene sold to Franco-Nevada, where Coeur d'Alene sold roughly again 40,000 ounces of gold production a year at $400 to Franco-Nevada in order to build the Palomajero mine in Mexico. Coeur d'Alene had started building the mine and had cost overruns and couldn't finance the completion of the mine because they couldn't borrow any money against the mine because they never did a feasibility study. So the bankers weren't certain what they really had. They needed $75 million, and which Franco loaned them, and that $75 million got paid back in a little less than over a year. So that was a great deal. So there's a lot of these stream deals can be very good. It's getting more competitive. I don't know that we're going to see deals as good as either the Franco or the Royal Gold deals I mentioned were, but they're still very good. They're very high margin, and as long as the mine starts up and operates fine, they're going to be big producers for the royalty companies.
It's interesting because once they take these royalties, they're for the life of the mine, which could be over a decade, but if you really look into these contracts, which, a lot of people, regular investors won't do. I mean, it's not their job to do, but it's almost that when you're looking at the deals, it's not only that they could buy, at least from the company I recommend, and I know Royal Gold too, which I'm familiar with, that even if they have little clauses in there where if gold prices come down below $1,000, then it's not $400 we have to pay. We have to pay $300. And some of the even smaller ones are like, we'll do this deal and get warrants on the side because everybody knows a lot of these companies are starving for cash, but they have good property. So right now, if you have cash, I feel like cash is king. A lot of these royalty companies all have cash in a market where everyone's starving for cash, and they could almost just lowball and make these crazy deals. It seems like the royalty companies, they shouldn't be down as much as the market, and they still are, aren't they?
Well, some of them, Franco-Nevada, which is probably the premier one, is down from its all-time high. Its all-time high was about 60. It's down at 45. So it's not fallen by 50% like Royal Gold fell from more than 50% actually, from just under $100 to just under $40. Because Royal is tied up in a big stream deal with a copper gold project in British Columbia that I've been to, called Mount Milligan, and last year there was some uncertainty as to whether or not the project was going to start up on time, and now it has started up on time, and Royal's recovered back to the mid 50s, and probably will go higher as Mount Milligan, which is going to develop going to spin off to Royal 140,000 ounces of gold a year at $400 cost per ounce. So it's a huge royalty stream, and it's one that'll benefit Royal, ad infinitum until the site runs out of gold. And of course, the unique thing about most mines is that when you're drilling and you're exploring to figure out how much gold is at the mine, you don't drill off every last ounce. You drill off enough to get 10 years of production, and then you start financing the project and get into production. There's more ounces there, but it doesn't serve any purpose to figure out that there's a 15 or 20-year mine life, because 10 years of production is enough to finance any mine, but the likelihood is you'll find a lot more ounces if you're there and you're exploring and you're living on the site. And so a 10-year mine life to begin with often can turn into a 25 or 30-year mine life without a lot of work, just over time and drilling off and spending time on the ground.
And I want to finish with this, John. Could you share, we looked at Franco-Nevada, Royal Gold, and you talked about a couple of other stocks. Do you have any ideas to share that you're not giving away anything in your newsletter, which a lot of people pay a lot of money for? Maybe a couple of ideas to share. If you do, or a couple of stocks that are just have done so much that don't deserve to be, that you really think could have a really good year this year.
Oh, that's really hard because if one of the things about having a 10-stock portfolio is that we do not want people to buy just one stock. I mean, the way to lose money in gold is to just buy one stock. You hear a story that you like, and I meet people all the time at a cocktail party. They tell me, "Oh, I bought this one stock; it just went down." You have to buy 10 stocks in order to diversify the risk. The one stock that somebody bought could be in a country that changed its export regulations. It no longer lets a mine do whatever it was doing when it started up. So you have to diversify and own a bunch of these stocks, and we think 10 is the right number in order that you can take the upside and the downside risk of the miners. If everything goes right, you'll make a ton of money, and if everything goes wrong, you'll be protected to an extent on the downside. The stocks in our portfolio don't go down 90% like an exploration stock can when they can't get any more financing, that kind of problem. So I really hesitate to give out any thoughts. We do have thoughts, and in the top 10 we talk about stocks of interest that are not top 10 in our top 10 newsletter. They're not top 10 and companies we've looked at and examined, and they might be top 10 at some time in the future. A company we've done that with is Torex, which has got a big deposit down in Mexico. We've done it with Pretium, which is working on a big site in British Columbia, and we've done one or two others. We sort of throw it in every few months when we find a company that's of interest. Doesn't mean it will be ever top 10, but it's one that subscribers are asking about, or we've been to visit the mine because we'd heard about it and saw like what we saw, but we're really pretty tough on our top 10, although we only have top 9 right now, so we are looking for a number 1 or number 10, but we don't have one exactly in mind right now, but who knows what'll happen tomorrow.
And last question here, John. I'm still waiting for that invitation on your boat. When's that going to happen?
Frank, you have to be down here to do that. You could come to our Investor Day on February 23, and then you'd be in the area, and I'd be glad to take you out. And either on the 22nd or the 24th.
That sounds great. And real quick, I'll talk about your Investor Day, which is fantastic, because you have a great conference coming up on February 23rd. Your keynote speakers are fantastic. I mean, Franco-Nevada, is one of them that you mentioned. Royal Gold's another. I'm not going to give away any more because those are the stocks in your top 10. But talk a little bit about your conference really quick.
Now for a couple of years we've been having an Investor Day on this year. It's on February 23. It's always towards the end of February, and we take over a building at the Hyatt Pier 66 Resort Hotel, which is on the Intercoastal Waterway in Fort Lauderdale. And it's an all-day event that starts at 8 o'clock in the morning with coffee and pastries, and we serve lunch, and we serve appetizers and drinks at the end of the day. But we have the 15 companies that we recommend, the top 10 gold stocks and the favorite 5 silver stocks. We have a silver letter as well. The top guys all come and speak, and last year we had Jim Rickards, who was a keynote speaker, and he wrote the book Currency Wars. And this year we're having probably the smartest guy. If you had to pick, CNBC is doing this contest about the top 25 guys in finances. Well, if you had to pick the top single guy in mining over the last couple of decades, you probably would pick our keynote speaker, who is Pierre Lassonde, who basically invented the royalty streaming model, was very responsible for starting a number of companies, including Franco-Nevada, and he's just an overall very smart guy, and he'll be keynoting. But we've got top guys from all the top 10 and favorite 5 companies coming, and it's an all-day event, as I said, that starts at 8 o'clock in the morning with presentations beginning at 8:30, and it runs until 5, and then we have a cocktail and appetizers and a chance for attendees to rub elbows with the speakers and the people who work at Gold Stock Analyst, and it's a great time. And it's in a great site along the Intercoastal Waterway. Next door to the building is Steven Spielberg's Seven Seas boat. It comes here every year before it goes to the Cannes Film Festival. Last year we were still at the dock, so maybe it'll be here this year. It's only 280 feet. We're going to try to get him to come and subscribe.
That's great. So maybe I'll get invited on that boat as well. But and if someone wants more information about the conference, how could they contact you?
Yeah, go to the website, goldstockanalyst.com.
All right, sounds great. John, thank you so much. I know how busy you are. Thank you for being on. A lot of people interested in buying gold now as well as I am, so it was a great conversation. Hopefully you join us again soon.
Great. See you at the end of the month then, Frank. Thanks.
All right, guys. Hopefully you liked that interview with John Doody. I think it's fantastic. Gave me a lot of ideas. John's a humble guy. Again, he has some of the best returns in the business. Everybody got killed in gold stocks, at least over the past 18 months. So did John. He's very humble about it. But right now, I think that this is maybe one of the best newsletters you could subscribe to. I don't get paid for that if you do subscribe. If you want more information, attend his conference. I think it's in Fort Lauderdale, he said. So, and I just saw that the guest of speakers, a lineup. I wanted to ask him about that. I'm glad I got that question in. And he has this every year. He does a ton of work. And, when he's got guys like Franco Nevada and Royal Gold going to your conference, that shows you how big shot, John is. So he's a big shot. Again, he's humbled by the losses last year. Not too many guys will tell you the percentage that they lost, and he did that. That has to tell you, from my experience, I like investing in great managers and great people coming off bad years. That's why you're seeing a lot of gold stocks starting to show up in my newsletters. And we're writing about that in phase one for the next issue next week. So if you want more information, you could go to John. He gave you his email address. Email me, fkurzer@stansberryresearch.com. Now, let's get to the markets. Seen a big sell-off in stocks. Everybody's nervous, even though we're down, like 4% from the highs. Of course, that's after a 25% plus move last year, most of the major indices. Earnings have not been great thus far, right? We usually 68, 70% beats. We're more like 50, 55%, almost halfway through. Again, small caps are going to report starting next week, going forward over the next 3 weeks. Should be interesting because a lot of large caps are missing. We saw Apple come out. They reported weaker than expected iPhone sales. For me, I don't know if I expected weaker iPhone sales, but I did expect Apple to sell off because everybody had them going high. It's going to be a record quarter. It's going to go high. I felt like they were going to report decent results and then a sell-off, but the results were not really that great. But they did have stronger Mac and iPad sales, but iPhones is the key growth driver. That's what everyone's looking in terms of growth. That's the question with Apple. Where's the growth? What I thought was interesting, I think it's like 65% of people in the U.S. have smartphones already, so you're not looking at a lot of room for growth in the U.S. Emerging markets, of course, we know the deal with China. Again, it kind of stinks when you're that successful. You're a world-dominating company like Microsoft, Walmart, Oracle, IBM. They've all gone through this process where they trade at high multiples, and then you become a value company like Apple's becoming today. And you're seeing a lot of managers jump on board. It took 10 years for Microsoft to really get out of their rut and finally going higher now towards old highs. When you look at all those companies, they're all monsters now, and it takes a ton to move the needle on these companies. If you need Apple to find the next big invention, the next big device, it has to be big. And by big, I'm talking about $20 to $30 billion product over its life. If the life is like 4 or 5 years, and it's going to be hard to achieve double-digit growth since the company generates $170 billion in revenue each year. So, if you're starting out in a company, you get $1 billion in revenue, you're high-fiving, so you're like, wow, this is the best thing ever. It's meaningless to Apple. You have $170 billion in revenue. Just to understand how big that is, big data market, one of the biggest trends in technology, is said to be a $25 billion market. So if Apple captured that whole market, it wouldn't really make the biggest dent in the world when you need to generate $170 billion in sales. You're looking at IBM, $100 billion in sales. You're wondering why the stock went from 200 to 170. I don't think they're going to be able to generate $100 billion in sales for IBM. Maybe Apple could do it. You're selling those high-end products. For IBM, it looks like they're scrambling right now, trying to get into different markets, focusing more on big data. Again, if they took the whole big data market, $25 billion, just to explain how big these companies actually are. So, for Apple, we're probably going to see a trading range. I mean, what is it, 475 to maybe, 550, 600, maybe for a while. I mean, maybe we fall a little bit below that and then becomes a buy. It goes higher than that. But unless they achieve those growth statistics, it's going to be hard to see that company trade 650 or higher. And again, it's just remarkable how many $1,000 target prices, and everybody loved this stock at 600, including me, because of the China deal. I thought it's amazing. And now all those target prices, Goldman downgrade. They had like 5 or 6 downgrades over the past couple of days. You're seeing target price get cut from 750 to 550. $200, not that big of a move, right? In terms of market cap, it's a monster move. It's a monster move to cut your target price that much. Just interesting. But what's really pushing stocks lower, of course you got that Apple quarter, but and earnings, you're looking at emerging markets, right? Big risk again. Turkey, Argentina, really bad shape. You could throw Brazil, Indonesia, Ukraine, even South America South Africa, in that conversation. But overall, growth is slowing. And this is one of the most interesting stats that I was able to pull from the IMF. The growth gap between emerging markets, remember, they're supposed to grow a lot faster than developed nations, and the developed nations is the smallest in over 13 years. Interesting, right? That's either telling you that developed nations are doing better or emerging markets are doing worse. I think both is happening. We're seeing strong growth in America. We're seeing Europe rebound. And we're seeing emerging markets like China continue to slow further. I mean, nobody really predicted that trend a couple of years ago, right? All the growth's coming from emerging markets. It's going to be over 20 years. Just interesting to see that stat. Maybe it reversed itself. That was just a surprise to me. Now, what does that mean? Well, it could suggest that high beta stocks move more than the market and, growth anticipation, they may be out of favor. I mean, those are companies that, if you took the 20 largest short positions in at the end of 2012 and bought them, you're up like probably an average of 80%. I mean, these stocks have just gone through the roof, everything, like the Netflixes, you can just go on, it's Tesla's, just the huge short positions, they got blown out of the water. Be careful with these stocks in a slow-growing environment. If we see the U.S. start slowing, we're seeing GDP pick up. These high beta stocks are going to be the first one to get hit. Maybe value comes back into play. Let's see how this plays out. Again, it's early. I don't expect a huge crisis here. I think the word crisis is a tie for the most overused word on CNBC. It's tied with bubble. Bubble and crisis, fun words again to scare the hell out of you. We're not in a crisis here. I think that, we're overdue for a pullback. Now we're starting to see it. We also saw a durable goods number that was a little weaker, actually a lot weaker than expected. I've been saying this for months, make a list of stocks that you would buy 20% lower. I know it sounds crazy. I'm even writing a phase 1 issue about this next week, but, you're like 20% lower. Well, you got Lululemon, Bed Bath & Beyond, International Gaming Technology, Kansas City Southern, Kohl's. They're down 15% plus this year. Guys, it's not February yet. They're down this year. So it happens. And you're putting these low ball offers in and saying, well, if Kohl's comes down, I really like to buy. You're getting the opportunity. I'm not telling you to buy Kohl's. I haven't done the research on it. But your favorite stocks that you'd like to buy, be patient. It's a weaker market. Let the market come to you. For the first time, you're going to have that opportunity in a year, right? Stocks have just been blown out of the water. But make a list because I think we're going to pull back a little bit more. But remember the big picture here. The Fed's going to keep interest rates low for another 3 years. They're going to inflate the markets further if we see an even bigger decline of 10, 15% plus. And that makes U.S. stocks one of the best places to invest, at least over the next few years. So, think of an analogy that, you probably read throughout Stansberry. A lot of people use it where, you have a sprinter, you have to slow down a little bit. That's what you see with the markets before you can regain your composure and go a little bit faster. So, it's almost like the market's taking a breather right now. You're going to see it, but the macro picture is still in effect where, interest rates are low. The Fed's inflating the markets here. It's going to happen for a while. And I think that, at least for me, I'm picking away at a lot of stocks here from my personal account. Stocks are down 20, 25, 30% in the small cap world that I really, really like. And, I suggest doing the same. Again, everyone has your list of stocks that you like, but be patient. You don't have to chase. You had to chase last year. You don't have to chase this year. Things are going to come back to you, so definitely be patient. Now, let's get to my educational segment real quick here. Been doing a lot of research on this. As you know, I've been to the Consumer Electronics Show. I sat through a ton of presentations. One presentation I thought was interesting was Cisco, talking about connectivity, how all the devices in the world are going to be connected to each other. You guys probably heard of this trend before. It's called the Internet of Everything, IoE, right? It's been mentioned for 2-3 years, even longer for the tech geeks. Hasn't really come to fruition yet, not even close. As Cisco says, more than 99% of things in a physical world remain unconnected. That's from Cisco. They're saying every device you use, and again, when you say connected, yeah, I'm connected to the internet, but they mean your car, appliances, television, alarm system, thermostats. I mean, everything is going to be connected through your mobile phone, tablet, PC, and we're just on the verge of doing that. One of the biggest trends in technology today, how big? Cisco says that this market is $17 trillion. That's how much money this trend is going to be in terms of productivity, in terms of gains. I mean, Cisco did a great job, and I sat through this presentation Showing pictures of a customer pushing a shopping cart in, looked like a home improvement store, like a Lowe's or something. And the shopping cart had a small electronic device attached to it that tracks the cart. So the customer can call for help by pressing the device. And this is where IOE, Internet of Everything, comes in. The customer needs help. The store can assign the proper employee to answer those questions. Not every employee, as you know, at home in Lowe's or wherever you go, any home improvement store, Home Depot, whatever, is not a specialist in everything. Some are a specialist in electricity, some in the paint section, some in lumber, whatever it is. You want the right guy answering your questions. And more important, the interaction between the employee and the customer is documented. And you have the stores going to keep records on how much money the customer spends, what they're interested in, if they own their own home, where their favorite places within the store are to shop. And all this gets tracked to determine future spending habits. So it's almost like a big data trend by tracking all of this. And this information is critical to every business that sells anything. I mean, that's where the market's going. That's where the IBMs are investing. That's where the Googles are investing. I mean, even Google just spent $3 billion on a thermostat company. It's just, that's where everybody's going. Everybody's investing in this. Apple's getting it. Everyone's getting into this industry right now. And you're looking at, John Chambers spoke he was one of the keynote speakers at the Consumer Electronics Show, which I didn't go to any of them at all, the keynote speakers, because you waste your time basically, because you find out what they say 10 minutes after they talk. I'd rather talk to CEOs on the floor when no one's there. Instead, everyone's listening to these speeches of a CEO that's going to just tell them how great your company is. For Cisco, I don't think Cisco's the best play on this, even though I think it's a $17 trillion market. And to put that in perspective, and it's not even a $17 trillion. I mean, it's a $19 trillion market. I'm thinking $17 trillion because $17 trillion is the entire market cap of the S&P 500, all the companies pulled together. It's a $17 trillion market cap, right? They think Cisco, the Internet of Everything, is a $19 trillion market. That's how big they think this market is. I don't know. If they're half right, it's a monster market, right? We're looking at $25 billion for big data. I mean, this is beyond belief, the numbers that they're throwing out. But it's funny, because Cisco did a whole presentation on this. You had Qualcomm as well. Qualcomm, probably a better play on this. Cisco, look, their legacy business, their business all switchers, routers, and that business is expected to grow 1% annually for like the next 5 years. So the time this becomes a big part of Cisco's business is going to be a long time. I think Cisco's going to see a lot of pressure. Just saw a big downgrade on Cisco. I think they have a $16 or $17 target, which I kind of agree with. The better play on this, I think, is a company like Skyworks Solutions. A company like Broadcom, which got hit after Apple. You don't want the Apple pure plays like Cirrus Logic, but these companies have their chips in all these devices, especially Qualcomm. But I like Skyworks a little bit better. It's a lot cheaper, trading 11 times earnings, perfect balance sheet, no debt. They're in all of the devices, all the growth markets, and even in a conference call I listened to for Skyworks, which was fantastic, they actually mentioned how, we're seeing a lot of demand from connectivity where everyone's connecting to the world, which is the Internet of Everything. So these nuts and bolts plays, I think, are going to be direct beneficiaries compared to the Cisco's and Qualcomm's, where it's going to take a little while. Because Qualcomm, again, I like them as a supplier. They're very good, but they're monsters. They're huge. I think Skyworks, Broadcom are much better plays. You're already starting to see the benefit of this. I don't know if this trend's going to come out. I have a lot of tech geeks that listen to this and tech analysts and stuff. Shoot me over an email. Let me know what you think. But, I sat through this conference, through this presentation for Cisco for about 20 minutes. And, it was fascinating. I just don't see Cisco getting all of that data voluntarily like a Facebook, which is why I think Facebook is one of the greatest companies on earth, because everybody offers that voluntarily, where Cisco doesn't really, they have the data, but it's a long time before you get all the data. Like Facebook has everyone's data on everything, what they like, where they are. I'm checking in right now to this store. You could definitely, it's an advertiser's dream. I think Facebook is the best play on this market because they have all the data already, where Cisco is still going that route. So I don't know if Cisco's the best play in this, but the Internet of Everything is a real trend. I think it's going to be big, huge going forward, just for the fact that 2 or 3 conference calls, they all mentioned the issue of connectivity and how they're starting to benefit. Everything's being connected, appliances, cars, everything. So the fact that I'm finally hearing it in conference calls means that it's just starting, means it's here. And I think, companies like Skyworks and Broadcom are probably the best plays on the Internet of Everything. Again, welcome your feedback at Stansberryresearch.com. Okay, guys, that's it for me. Got a little football game coming out called the Super Bowl. Again, I have Denver winning score of 31-17 over Seattle. I know a lot of Seattle people, they're just gonna, no disrespect to them, but nobody on their roster in Seattle has been to the Super Bowl. I think Russell Wilson's the most overrated person in sports. Actually ranked 12th in quarterback ranking and has twice as many commercials as Tom Brady. I think he's a fantastic guy. I think he's a good game manager. I just think he's very overrated. He fumbled 2 snaps in the fourth quarter last game. He's very nervous. I can't see him performing. If you look at his last 4 regular season games, 4 TDs, 3 interceptions. So thank God he played those last 2 games at home in Seattle, which is the best crowd ever. I just don't see Seattle making this competitive. I will say one last note. I'm usually dead wrong at picking Super Bowls. I probably have like a 30% average, which is good. So when Seattle wins, everyone can send me emails, as many emails as you want. But I realized a long time ago when it comes to football, just flip a coin because it takes all the emotion and the research out of it. You'd probably be better off. But I do think that Denver's a much better team, and they're going to shine in this game. It's not just going to be Peyton, but it's going to be the Denver's defense. Should be a fantastic game. Have some beers, have fun, enjoy it. Don't think about the markets, the economy, or anything, and enjoy the Super Bowl and, spend time with your families and friends. And don't forget to visit us online at www.stansberryradio.com. You can subscribe to our mailing list, putting your little email in the box, getting an email address at stansberryradio.com. And funny, because you're going to see another radio show on Stansberry Radio. It's James Altucher. Decided to join our company, has his own radio show, already ranked #1 in iTunes his first week. I've had James Altucher on a lot. He's a friend, brilliant guy, humble, smart, has a ton of contacts, which he's going to share with, not only with us, with our entire company, but also with everyone listening to his radio show. Give a listen to it. It is fantastic. I'll probably be on his radio show pretty soon. He has fantastic guests, and I'm just happy to see Stansberry really adopting radio now because I think it's such a great outlet. I appreciate all the feedback. I love it, and it educates me. It makes me smarter from the people I interview, like John Doody today, the Rick Rules and stuff, and also from all the emails I get for you guys. So I just want to thank you, and definitely check out James Altucher's radio show. Also, be sure to visit our free sites, growstockwire.com, dailywealth.com. You can catch articles from me, Steve Sugarrood, Porter, Matt Battiali, Doc, Dan Ferris, everybody. And if you have any comments about this show or anything, the economy, my newsletters, email me at fcurzio@stansberryresearch.com. That's fcurzio@stansberryresearch.com. And also email me if you want that $39 special for my small cap dividend elite stock portfolio of 5 stocks. Again, it's worth all the money in the world. Money managers charge 1-2% to put you in some of these stocks sometimes, and you can get it for $39, which is kind of a joke. But again, it's just my gift to you to say, hey, you know what? It's covering the cost. It's a fantastic product for you, and I know you'll be part of my newsletter for a very, very long time if you do subscribe to that offer. So, thank you so much for listening. Enjoy the week. Be safe, and I'll see you in 7 days. Take care.
The information presented on S&A Investor Radio is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.
S&A Investor Radio is produced by Stansberry & Associates Investment Research, the leader in investment newsletters.